The first day trade of the morning in the Sector Secrets Mastery was gold. And I'll tell you, when I look at this one, it's a tough one to be too excited about, even though the first trade of the morning was a winner. But I'm going to walk through what disciplined trading on day trading looks like. And first up was buying GLD calls, 20 October, 395 or 396. Now the lesson here isn't, what a great winner we had. The lesson here was discipline. Really simple. The idea was to grab the long calls in the hourly price movement range. So this H stands for hourly price movement range zone, volatility-based support. All trading really boils down to support and resistance. That's the kind of trading almost everybody does. So why not get clear about what support is and what resistance is, so we can find zones to get in and then find zones to pay ourselves at. In this case, gold futures sunk into the zone. Now notice, if you're a gold futures trader, awesome. Buy gold at 4324.8 or buy gold at 4320.8 or buy gold at 4317.1. Whatever it may be, you can play GLD, MGC, or GC. Now in this case, the first scale out was 4331, which is right here in the middle, almost upper middle of the zone. We hit the level. Actually, we hit it a couple times. Notice it didn't do much. And then all of a sudden, right at 9:55, the thing tanked. Now for me, having paid myself up at this level here, this represents a break-even close of the trade. And this is something most traders don't have the discipline to do. So while I wasn't in on all of this, I still took a nice quick winner. This here is not something that I'm going to trade. What happens for a lot of traders is they get in, they don't pay themselves when they can, and then something like this happens, and sometimes more of this can happen. This might have been some news, don't know, don't care, took my winner, and then break even. Now let's take a look at what I bought, which were the October 20, 395s. If I can go in or at the money with the strikes, I am perfectly content. That's the idea. Make sure that I'm not out of the money with a strike. That's not my style. And I don't want to have to make up the out of the money strike with a lot of movement in favor of the trade in case we don't get it, right? So this is what this trade looked like. This was the zone from which we got into the trade. And you can see that the variation, the average price was about 160 bucks per contract. And then when gold shot up to our zone, again, these are the 20 October 395s. As it shot up into our zone, you can see that was a decent amount of return, right? I mean, it's not obviously, look, this kills me. Part of my brain is thinking, why on earth? But the other part of my brain that's never blown up an account, who luckily rules my trading life, says we could have moved in the opposite direction. This thing could be worth nothing right now. One of the other adjustments we made is we kept a pretty tight stop loss if the trend was lost. So risk is initially 25% on premium paid. So I mean, think about it, gang. We're risking 40 cents per contract. I'm not risking all $1.60. That's just generally a really bad idea. And that was what happened there with gold. And look, if I can take $1.60 to $3.10, $3.20 or above, and I can get a nice return on something like this, I'm pretty happy. If we could hit a 100% target, that's fantastic. If we can't, so be it. A winner's a winner and we move on. So discipline all the way. The next trade that we set up was based on the Russell. So once again, you're going to see that I'm going to put the RTY on the screen, because even though I'm trading IWM, I'm watching the 23-hour version of the symbol, not the 9:30 to 4 p.m. version of the symbol. So you can trade IWM, you can trade RTY futures, you can trade the micros on RTY. Lots of flexibility with this approach of using the futures contract to trade all the other symbols like the ETF. And you have lots of choices. And a lot of times, if I've got the luxury of time, I'll buy both the futures and the ETF sometimes. So we set this one up just before 10 o'clock. So right before here. And you can see exactly what this was. Right? This is just a really classic setup for us where we're looking to buy into a move lower into support. Gang, I don't care whether it's support levels. I don't care if it's support zones, resistance levels. Why is the line there? Well, for me, it's either going to be because of volatility. It can be sometimes because of volume. And it can be oftentimes because of price. So why the level is support or resistance is far more important than calling it a name like floor, ceiling, supply, demand, buyers, sellers. The why is what matters. Why is that level there? So in this case, I'm going to talk to you a little bit about position sizing on this one. So this trade triggered. The whole idea was to buy the IWM here at 10:16, just after 10 o'clock, as price sunk down to this area between 2493.2 to 2493.5, anywhere in that area. Once price is trading down into that zone, not back up through it, but down into that zone, we buy the IWM 20 October 245 call. So this candle here, this red candle, is what you want to take advantage of, not the yellow up candle that followed at the 10:20 5-minute candle. The momentum dictates where you'll be able to get filled. If price is sinking lower, you're going to get a fill at the bid or even lower. But if price is going higher, you're going to have to pay up. You're going to pay up at the ask. So we want to be able to get this thing at a really good price. And you'll see here, 20 calls, 245, tight stop, because the price action here I wasn't loving. So tight stop on that level. Now, what is the support level here? Well, this was an interesting one. So this is the first time I think I've talked about this in one of the recaps. This is a 9:15 candle, 9:50 a.m. Eastern, and all I'm doing is pulling basically a 50% retracement on the 9:15 5-minute candle. Now, there's a zone here. The zone extends to the 61.8 to the upside, and the 32. So if you want to basically make it really easy, half, right? And then basically this is 1/3. This is 2/3. We can get really fancy about retracements and Fibonacci, but at the end of the day, if you can find that 50%, which runs right through the middle here, you're in good shape. So you take the 9:15 candle, cut it in half. All right, I'm a big fan of keeping things really simple. Take the 9:15 candle, cut it in half, and you get this really cool zone. And that's what this was. Now, I call this very aggro because of that zone. It's not a zone that I would say is a main staple in my trading, but I always have that zone on my screen. I'd much rather use a Darvis. I'd much rather use an hourly price movement range, but this was really a very interesting zone to use. So what we did is we adapted by reducing the desired account risk, which reduces how many dollars we're going to spend, and we tighten the stop loss. Right? So if I'm wrong, I'm going to know 15 cents on the dollar into the trade. Really important adjustment. So if you take a trade level that you say, this is not one of my bread and butters, but I've tested it. I know it works. The circumstances, the structure is right. I want to take a shot at it. You don't want to overload on that position, but you want to take the opportunity to be able to profit from it without disproportionate risk, which, by the way, is what adding to losers and things like that do. Yeah. So this was the zone. These are the 245 calls. So by the 245s, October 20. And the idea was, again, buying into this little dip here. That's really it. That's really it. Taking advantage of that move. And then on the way back up, T1 at 2502.7. And then we were looking for a T2 and a T3. So let's go back to the chart here, and I'll walk you through how we think about multiple scale outs. You'll notice I have multiple scale ins. What if the trade keeps going in our favor? Well, the idea is to get in when we get the opportunity, pay ourselves we can, not when we have to, which was right in this area here. And then if the trade keeps going past T1, well, what about a T2? You'll see here, T2 was 2509. Okay, well, that's right up in here. So we're looking at a 2509 second target. And as long as price stays above the T1, I'm allowed to stay in the trade. Now, in this case, it hit the T2, came back to T1. I locked in some profit and closed the trade. Today's pretty volatile. It's been all over the place. Gold was a great example of this. But I already took profit in this area, so I'm not really crying over spilt points here, sitting at 25.12. We took 2 targets. We were done by 11 o'clock. And if I can put about an hour's worth of work in, find my setups in that hour window, and I know what my targets are, after that, I don't have to be at the desk. I can place alerts, and I can be aware of when those levels are reached. I know that I want to scale out. I know where my new stop loss is because it was the old target. So, you know, if we're able to do this 4 or 5 days a week, 1 or 2 trades per morning in this 60-minute window, that is something that I think everyone can find the time to do. And it's something we do every morning in the mastery. So IWM trade was pretty nice. And again, I think the problem is a lot of traders say, well, Rog, how could I have hung on here? Same thing with gold. And for as many times as this can happen too. So what happens to a lot of traders is they might have some really good profits. They get greedy or they forget the risk management and they end their day with a loss. And we just don't want to do that. So if I know by 11 o'clock, 10:30, 11 o'clock, I can pretty much be at a positive for my day trading, that I have more money in my account at 11 o'clock than I did at 9:30, I have done my job while managing risk. And that is what we did this morning.